Happy NVIDIA Day, everyone. Today is Wednesday, November 19th. After the closing bell in the US today, NVIDIA will reveal its latest quarterly results. But given the mood in the market these days, it is quite hard to imagine how even stellar results tonight would reverse the AI spending worries and the growing angst across both tech companies and developed markets ballooning debt levels. So don't be too hard on Jensen Huang tonight if he can't lift the heavyweight today. Welcome to Swissquote's Daily Market Talk. We will talk about NVIDIA, of course, and much more. But before we do, and as always, keep in mind that opinions are my own, and this is not financial advice. So the day has come, ladies and gentlemen. The biggest, and for some, the most important company of the world, NVIDIA, is about to reveal its quarterly earnings. So my crystal ball is whispering that today, after the US closing bell, NVIDIA will probably dump another set of jaw-dropping numbers on the table, probably a few more billions in sales revenue than the 55 billion US dollar expected by analysts, which would already be a nearly 60% growth compared to the same period last year, mind you, and a gross margin of ideally more than 73%. And then the company will probably give another stellar guidance for this quarter and remind everybody out there that China wants their VIP client doesn't matter as much as it once did in their forecast. And Jensen Huang wants everybody out there, every investor, to assume that its Chinese revenue is zero. And anything more than that would just be the cherry on top. But what my crystal ball doesn't tell is how investors will be reacting to NVIDIA results tonight. Because everyone out there is now much focused on the worries that the huge spending on AI is just too high compared to the revenue potential, and also on the rising anxiety around the circularity of the recent AI deals. Another one just dropped yesterday between NVIDIA, Microsoft and Anthropic this time. The former two, so NVIDIA and Microsoft, will invest a combined $15 billion into Anthropic, and the latter will buy computing power from Microsoft's Azure that, in turn, will be powered by NVIDIA chips. Told like this, the whole AI thing does sound like nothing more than a handful of companies in the US and in technology sending each other billions of US dollars without hints of money flowing inside the circle from outside. But it's like McDonald's buying beef and tomatoes for its burgers. It must do it, and eventually someone will buy the burger. When and how much, we will see. Add to that the fact that the Japanese yields are now at the levels Japanese investors may prefer bringing their money back to Japan, and you got a pretty critical picture, to say the least. Above around 1.70% for the 10-year JGB, people are screaming that borrowing yen and placing it in US treasuries is not making money anymore after taking the FX hedging costs into account. As a result, the Japanese pension funds, who are huge buyers of US treasuries, are reportedly pulling 1.1 trillion US dollar out of the US treasuries right now, meaning that one of the biggest treasury buyers of the world is now turning into a net seller. In plain English, the Japs may be pulling the rug from under the US treasury market that also funds riskier investments like technology, EM stocks, and cryptocurrencies. So maybe we will simply be blaming the Japanese if the Bank of Japan dares hiking its interest rates come December, and that Santa remains stuck somewhere where there's still some snow this Christmas. But on a more optimistic note, just because I want to keep smiling this NVIDIA Wednesday, I don't think that the Bank of Japan will gather enough courage this December to move rates higher. They don't care about your NVIDIA or crypto portfolios, but they probably do care a lot about the Japanese economy that already contracted nearly 2% on an annual basis last quarter. And looking at the stress level in the JGBs, well, they know better than you and I that a rate hike would trigger a lustrous kind of mini budget crisis in Japan. And they also know quite well that a severe earthquake in the JGB market would not only shake Japan, but it would also trigger a tsunami across global financial markets, unlike the gilt crisis that we had under Liz Truss that was just fun to watch from outside. So if the markets don't turn to risk on after Jensen Huang pushes the on button tonight, it may be time for a 10 to 20% correction. And of course, some love adding fuel to fire, saying that the current valuations in the big technology stocks is based on a US 10-year yield of around 2% continuously. And so, if someone comes out and says, the emperor is naked, guys, and the new 10-year benchmark yield for the US is, say, more realistic, near 3.5%, while the valuations could even take a 30 to 40% hit. Now, it is simple math. Many of your favorite technology stocks trade 25 to 35 times their earnings, and a readjustment of the discount rate would compress them to 18 to 22 times. So for that, either your price falls 30 to 40% or earnings grow strong enough to counteract the higher discount rate. But maybe that thinking is a bit too simple. Because a month ago, when the AI deals were flying in the air, your average technology investor would, or maybe you yourself, would rather see earnings grow fast enough to neutralize the impact of higher US yields in the future. Today, all investors worry about is the rising debt. And right, debt smells worse when borrowing costs mount. And the mounting anxiety is pushing the credit default spreads to levels that some compare to the banks just before the subprime crisis hit back in 2007-2008, with CoreWeave, Tesla, and Oracle occupying the top 3 positions in the list of the companies that became the most expensive to hedge against a default in the next half a decade. Oh yes, it's crazy that we went from AI is everything we always dreamed of to this is a worthless bubble and screw you, OpenAI. But I can tell you, when an outage at Cloudflare disrupted OpenAI and many other technology services yesterday, and my ChatGPT came up and gave me a message, an error message saying unblock challenges.cloudflare.com to proceed, I didn't know where to go and what to do and to whom to ask. It was a small reminder that when ChatGPT is not around, it doesn't feel the same. So my reason tells me that there should be a midway between these two extreme scenarios. So the relentless rally in AI and that 30 to 40% meltdown in valuations. Perhaps Nvidia and other chip companies will continue to sell their chips to technology companies and grow their fortune. The technology companies will continue to develop their AI models, rent data centers to run them on, and sell their products to companies that are outside the technology buddies, say healthcare, banks, hairdressers, tax offices, McDonald's, and anything that you could eventually think of. And revenue will eventually flow in from outside the AI circle towards the inside. And as per spending, it will level out when the first booming phase is over. Maybe there will be a financial crisis before we get to the safer side of this bridge, but eventually the world will survive. If not, robots will come to the rescue. And while this all happens, the central banks will be there to temper any potential crisis in the markets, and the world will keep running. So stay well, think positive, and maybe keep an eye on the feminists as well, just in case. So this is all for today, and before the Nvidia earnings, I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.